Hello there, everyone, and welcome to our end of February edition of On Track. And when I say end of February, that's the performance numbers are up to the end of February. All the news is live and up to date. Up to my date of recording, which is today, 31st of March. I'm recording this from sunny Melbourne, and it's been an interesting month. I've been traveling around the country in between being at the office, traveling around the country training GPS advisors, which I do about twice a year. It's been fascinating to go through most of the airports around the country. We've got masks in all airports in Australia at the moment. And as I'm speaking, Brisbane's in day 2 of a lockdown. So it's quite ironic that I'm in Melbourne, and Melbourne's got no active COVID cases in the community. Business is back to normal, and here's Brisbane going to lockdown. It's almost the reverse of a year ago. Let's get into it. And today, as always, this monthly video is designed for clients of McGregor Wealth Management, and particularly those that use our care methodology and care investment process. For people who are stumbling upon this from outside of that group, you're welcome to watch, and I hope you get something out of it, but you should seek advice before acting on anything that we talk about. And today I'm going to cover the latest economic news, put it into context about and have a look at what key markets are doing. We're going to look at the returns of markets and the portfolio. I'm going to focus in on vaccinations. We're up to what to expect next, what's happening in countries where vaccinations are more advanced in terms of cases. I'm going to reiterate the good news, bad news cycle, particularly putting the end of JobKeeper in context. And I'm going to talk a little bit about the hot property market that's happening pretty much all around Australia. And as usual, put everything in perspective on what it means to you and your plans. So we look at the news highlights for the month. We're seeing vaccines roll out around the world. Australia's started. We're definitely at the back end. I'll show you some statistics in a minute on what's happening in different countries around the world. And we're seeing two tiers of COVID cases at the moment. In countries where vaccines are being rolled out, we're seeing cases decrease. But in countries where that's a bit slower, we're actually seeing cases increase, and particularly in some of the third world and second world countries. Good economic data continues. We do have the end of JobKeeper happening literally today. End of March is the last of JobKeeper. That's a bit of a concern given we're going into lockdown in Queensland, and it's going to be interesting to see. The market didn't react too much though, so the market's seemingly not that worried about it. A quick glance at some of the rates here. No change to the RBA cash rate. It's still low. 90-day bank bill rate's incredibly low, 0.01% to 0.03%. It's risen. 10-year government bond yields fell slightly last month after a big increase the month before. The Aussie dollar's fallen a bit as well, not substantially. Inflation, we're waiting for the next quarter's numbers, but the last quarter still sitting annualized inflation at less than 1%, 0.9%. Seeing mortgage rates in that mid-twos, you can get lower. You might be paying higher. Anyone who's on a mortgage should be talking to their bank or should be looking at refinancing if you're not getting rates in the twos, or fixed rates starting with ones. We're seeing fixed rates as low as 1.7, 1.8, 1.9 for 2, 3, or 4 years, depending on the exact timing. So if you'd like, if you're not having much luck with your own bank in renegotiating, give us a yell. We've got some very good people we work with who can have a look at the market and see if they can get you a lower rate. For some of our investors that have, say, $1 million debt on a couple of investment properties, 1% saving is $10,000, so quite material. And term deposit rates are falling and are going to likely fall further. Someone with $2 million in cash and term deposits at the moment is getting $7,000 in terms of their interest. So $2 million and $7,000 of income, and someone who'd spent all their capital, a couple in retirement, gets $37,000 on the age pension. So we're seeing a lot of retirees come to see us about how they can invest better, and we're talking about how. And if you've got friends or family that are worried about their low cash rates on big term deposits and they've been a bit scared of the markets, I'm more than happy to have a chat to them. They really only have three choices when you're not getting enough income from your cash portfolio. You only have three choices. One is to spend less, not a very nice choice. The other is to spend capital, not necessarily a very nice choice, but better than not spending as much. And the last one is to risk some of that capital in the sensible way that we do it for most of you guys. So yeah, a lot of scared people. There's been a few rorts and scams out there where then they're targeted at people who are used to getting decent term deposit interest rates. And yeah, watch this space. We're going to see more of that. Be very, very careful. And if you're listening to people who are talking about high returns on bonds and things like that, they're being offered anything above 3%, tell them to be very careful. There's a few scams out there at the moment. A couple of interesting charts here. The chart on the left is the consumer confidence, which is the red line, and the blue line is business confidence. And we can see it wobbling along. This chart goes back to 2006, the fall that happened during the GFC, and then a steady wobble up and down as the world does different things, but then it dropped off a cliff during the initial phase of COVID, but it's bounced back really strongly. And this is what markets are forward looking. So they're seeing this confidence, they're seeing this spending. And if you look at economic activity trackers, and this tracks things like, this is a leading indicator, so it attempts to forward predict what's happening with GDP. And you can see in Australia, we're well back above the trend of a year ago. US is getting back there. Europe's still lagging somewhat. And this economic activity includes things like restaurant bookings and things like that give us an indication of where GDP might be going. So very good for Australia, not so bad for the US. Europe still lagging. So let's have a look at returns, and these are returns to the end of February. And I'm going to talk about lies, and statistics, because to the end of February is the last the last month before effectively the markets dropped off the cliff. So this reports to February include the COVID downturn. Next month, you'll see when we get to the end of March, when we show those numbers, the returns are from the bottom of the market. So with reviews we've done with clients in the last 2 weeks, so since March the 24th, the annual performance is showing upwards of 30%. And I'll show you why that's not a number that you want to focus on as much as we'd like. Yeah, it's nice to know markets have recovered 30% from the bottoms, but they had dropped substantially. So just be careful when you're reading about returns or comparing returns of different funds that they're comparing exactly the same time frame, because depending on that time frame, you'll see massively different results. All of the care portfolios are delivering, over 3 and 5 years, well and truly at their target levels. And it's only the 1 year that's still a bit low, but in the positive, and you'll see that drop off in the next month. So yeah, we're happy with the performance of the portfolios and all doing their job nicely. Just to put into context, we do talk about the market's 3 main stages: boom, bust, wall of worry. We're quite clearly in the wall of worry at the moment. We're worried about lots of things in the market. That's the normal space of markets. We rate the markets at the moment as just a little bit above fair value, but it's a very tough market to give that with a high degree of precision, and interest rates being so low gives us a bit of confidence. So yeah, just a little bit above fair value. No reason. That just means markets are in their usual risk factor, and that means that markets, when they're in the usual risk factor, means there's a risk of markets going up about 70% probability and markets going down 30%. That's the normal. When markets get very expensive, up into that FOMO territory, that increases the risk of a downturn. When markets get very cheap or down to the fear level, which is what we were calling it exactly a year ago, then markets' potential for upside goes up massively. We've got a new index chart. So the index chart for 2021 is out. So it now shows the 2020 calendar year. So this is the chart you see in our office, in a lot of our videos, and in meetings that we have. So you can see at the top right-hand corner, markets have recovered. And I just put down the numbers there. I went through the last 4 years Zandex charts just to show what shares, which is the top line, Aussie shares, and balanced, which is the light blue line, have done. So you'll see, 2017, 210, 2018 was a negative year. It was the year the market dipped right at the end of the year, but then massively recovered in the next year. And you can see we're actually up for both shares and balance funds on the previous year. That's to the end of December. So it shows you that long, steady march of good investing when done well, and COVID's effectively been wiped out on the markets. Some interesting charts here about vaccine rollouts, and you can see the big chart on the left shows the percentage of people vaccinated, and it says here, and this chart comes from Our World in Data, a great website if you want to dive in and have a look. This is people who've had a first dose, so they may not have had the second dose. And it's interesting that it goes up to more than 100. But the quantum here is important. Israel are pretty much vaccinated everyone. United Arab Emirates up around 70%. And this was, these stats were about 3 or 4 days ago. UK and the US actually doing pretty well. UK up over 40% and climbing, US approaching 40%, and it's probably over that as we speak. And have a look at what's happening with new cases in countries that are being vaccinated. So you'll see the top right hand there in Israel. So Israel have had pretty much 4 waves: the first wave, the second wave, the third wave, and a horrible fourth wave, which prompted the quick rollout of vaccines. And you'll see cases dropping rapidly. That's good news. You'll also see that happening in the United Kingdom and the United Arab Emirates, where cases dropping as vaccine rolls out. That's good news when we look forward, and we expect that as we see other countries, including Australia, go through that vaccination cycle, that we will see cases drop, and then hopefully towards the end of the year, early next year, some return to travel. There's still an unknown factor about whether someone who's vaccinated can still spread COVID, but there's no doubt it will massively stop the number of new cases, which will stop the spread to a degree, and hopefully we're back at relatively normal travel, no doubt with the COVID stamp in our passports, sometime in the next 12 months. Just a reminder, those 4 pillars of a great investment strategy that we use in care, the core, the active, the reserves, and the enhance, based on these 4 pillars. And that's all investing based on your plans, your goals. And we take a lot from looking at history and cycles, but the number one thing that determines long-term performance is your behavior. And that's avoiding bad decisions, making good decisions, and not doing any of the easy things to mess that up. We'll talk about that in a bit more. I'm going to talk again about this framework of good news, bad news, and whether the news is a surprise or completely expected. So at the moment, and I'll use this around JobKeeper, every day we're saying JobKeeper's finishing, and that's bad news. So it sits on the left-hand side of the scale. Now, if that was a big surprise, the markets would go down massively, represented by that top left-hand corner. But because it's not a surprise at all, it's completely expected, the markets aren't changing, which is completely rational, the way the markets work. And it's only worse news or more bad news, once again, excuse my grammar, or less good news that causes markets to go down. So if you've got a market that's running along really well, and we're seeing this with tech stocks in the US, and all of a sudden the news gets less good, slightly slower profits, etc., you'll see markets correct, as they have a little bit in the last little while. And the same on the upside. For markets to go up, you've got to have good news, or news that's more good or better, or news that's less bad. And this is what we've seen in the last year. As we've come out of COVID, the news cycle has been less bad in terms of economic data. We've seen that in Australia with less unemployment than we thought, higher GDP growth than we thought, and that's caused markets to continue to go up. And once again, that pendulum swinging from fear to FOMO, the emotional reactions we have to markets, driving that news cycle. And it's always worth reminding us that every current fact and opinion is built into the current price. So, it's so hard to beat the market, which is why we use index for 70%, because to beat the market, you've actually got to have new or unknown facts and have a better opinion, which is very hard to do. And in the last year, we saw a lot of active managers very much underperform the market compared to index, because the natural reaction to COVID when it happened was to get out of shares, even for professionals. So that having a solid plan and the way we do it that kept us in has led performance to be pretty good. And once again, part of that is you'll see in the top right hand corner that difference. And I must get the Delbar's latest thing, but I got sick of updating because it shows the same thing, and that's investors left to their own devices will generally underperform the markets that they're in by about half for all of these reasons. And the media, we've seen that the media has just had it's loved the last year between COVID, US elections, and other things. They've kept people glued to the screens. The media dominated at the moment in Australia. Firstly, we had floods where they made it look like the whole East Coast was flooded. There was some very, very bad flooding in some parts of the East Coast. But I remember, from where we're sitting up on the Sunshine Coast, where we had a lot of rain, getting phone calls from people in Perth and the like saying, "Oh, you're still underwater," and looking out the window and seeing blue skies. But anyone affected by floods, thoughts go out to you. And in some places were particularly bad. But once again, the media has this habit of wanting to make it look like it's worse than it is and look like it's in more areas than it is. And I'm not going to get into any of these others today. Let's get into the market updates. And what I'm going to show you for each of the markets is the 12-month performance on the right and what it was showing last month. So once again, what a difference a month makes. So these charts are up to the minute. So it literally shows that if you're looking back now 1 year from 31st of March, when I'm recording this, it's nothing but up, and it's up from, around 4,500 to around 6,500. So about 40% in that year. And that's because we've dropped off the COVID cliff. So this is what this chart looked like last month. And, it was showing returns of negligible returns because the market had just recovered. That's still the case, by the way, because if we showed 13 months, it would show the COVID cliff beforehand. So once again, be very careful about what you're looking at. But Aussie shares, the important numbers to look at the moment are those 3, 5, and 10-year returns, which are all in line with expectations. If we look at US shares, the same story, up massively over the last 12 months to the end of this chart shows the end of March. The performance numbers are to the end of February, and you'll see very healthy performance numbers there for US shares. Once again, this is our return in Australian dollars, and it's very much been driven by the boom in tech stocks, particularly big tech, Apple, Facebook, Google, Amazon, etc. Now Tesla included in that, and they've come off a little bit in the last month as the more broader economic recovery is underway, and the market's rotated out of some of those high-tech companies into more traditional companies like Walmart and other industrials. And you can see the 5-year chart, just the steady march there down the bottom left-hand corner. But once again, be careful of looking at returns and comparing returns that don't compare exactly the same date. US small caps, absolutely amazing. 1-year returns sitting at 21%. I'm going to talk about some of the rebalancing opportunities that presents in our portfolios. So small caps always, when we're coming out of an economic recovery, tend to outperform large caps. They do a lot worse going into it, which was certainly the case this time. But you'll see in that 5-year chart down the bottom left, well and truly well above where they went into with COVID. But the small caps had been flat for about, they peaked in about November 2019, dropped down dramatically there and just popping up above that. So the 3-year returns are in line with where we think longer term returns would be. So we think potentially still fair value, starting to look maybe a tad over fair, but very comfortable holding small caps in the portfolios at this time of the cycle. Global leaders, this is the top 100 companies in the world. So this is the Amazon's, Facebook's, Apple, Microsoft, Tesla these days, amongst many other more traditional companies like Nestle, General Electric, Walmart, Roche, and others. Yeah, and another stellar year, up for the month, up for the year, up on all cases, um, slightly above their long-term averages. So slightly fair to just above expensive, but still very comfortable having the portfolios. Once again, note that contrast between this month and last month's charts, where COVID has effectively dropped off. So the performance of emerging markets, once again, a great 12 months, up 12%. They'd been lagging. You can see the 3 years still pretty placid at 5.5%. Once again, the importance of diversification, which I'll talk about in a minute. 5 years, a nice steady march, 12% over that period of time. 10 years, 6.5%, and we would expect, long term, about inflation plus 7% for those. And we look at gold, and gold's done the opposite of the share markets. It's steadily come down over the last 12 months, as the market has seen the risk come out of the economy. Gold's probably also lost a bit of its investments to Bitcoin. I talked about Bitcoin last month. You can go back and listen to that if you want to hear my opinion on Bitcoin. But there's no doubt that some hedge funds, some professional investors have switched some of their hedging assets out of gold and into Bitcoin. But supposedly for many, the promise of Bitcoin is some of the similar things to gold. And as I mentioned last month, I do think Bitcoin's in a bit of a bubble, not to diminish its role in the future, but the price has just got so high, it looks like that has to come down at some stage. So gold, really important part of the portfolio. It's done its job nicely. And it leads us to, once again, talk about the benefits of rebalancing. So you can see here, this chart on the left shows the last 3 months, just the massive difference between, say, small caps, which is the green line, and gold in the bottom. So at the last investment committee meeting, a week and a half ago, we took the opportunity to rebalance, which means we take a little bit of profit out of small caps, buy a little bit of gold, and these things add value over time. You can see that the chart on the right-hand side is over 3 years, and all these things kind of come together, but with the last year has just seen plenty of rebalancing opportunities, and rebalancing adds, we think 0.5 to 1% of the portfolio. You can see the performance of the active portfolio, and that's the constituents of the active portfolio there. In really good returns, driven partly by the asset sale there, but partly by the chance to rebalance regularly. And the active portfolio has that downside awareness where occasionally we take a profit. Let's get on to the hot topic of many conversations at the moment, and property. And it's a hot market. You see the data here, and CoreLogic, RP Data, who put this together, they do smooth data. I'm trying to get some better information on their exact source. I know registrations of sales in Queensland are behind, so I'm hoping the data is accurate that's coming out of these things. I'm assuming they know what they're doing, and it is. But you'll see here the month-on-month change around the country, all green, everything up. And these are big changes for monthly, where markets are up 2.5%. Obviously, if you annualize that, you'll get a big number. Change year to year. So you'll see down the bottom, Darwin, Canberra, Hobart, all up 10%. We're certainly seeing that. Brisbane showing about 5.8. So all up except for Melbourne, which is still showing down for the year, although we are hearing stories of Melbourne's rise. And that's houses. Units are slightly lagging, and particularly in the big cities, we've seen units in Sydney and Melbourne, vacancy rates go up, rents decrease, and that's led to some falls in some of those areas. The data's interesting, and I'm going to have a look at one suburb in a minute just to show you. Look at this, the National Property Clock from our friends at Heron Todd White shows pretty much everywhere in the country in that rising market. Pity about poor old Wodonga. I'm not sure what the local story is there, but you'll see pretty much everything is going up. It's funny how they change these things. The Sunshine Coast, they initially had it approaching the peak of the market. but they've brought it back to a rising market. And that's because circumstances have changed. What we're seeing in the market is people are bringing forward purchase of future homes, future retirement homes in places like the Gold Coast, Sunshine Coast, but also regional Australia, which is going gangbusters. With the lack of travel, people are, and with low interest rates is quite clearly the big driver here. They're able to buy ahead, and I keep hearing from local agents in around the Sunshine Coast that they're getting people from Victoria, New South Wales buying sight unseen, just inspecting over the net, getting massive turn-ups to open for inspections. And if you're not selling through an auction, in many cases, you're probably leaving some on the table at the moment. Although we've seen extremely good results where you're effectively getting auctions without having auctions. And we've seen clients who've been waiting for a good market to cash out of a property that they might have an investment just to top up their super and consolidate their retirement, all of a sudden hit the price targets they've had for the last 5 or 10 years. Units show much the same story, slightly lagging, and you'll see some of those units in places like Melbourne are only just at the start of that recovery. They will catch up as COVID washes away. People still do want to live in the cities, so I suspect that will catch up over the next few years. And as long as interest rates stay low, we're probably going to continue to see rising property prices. When that all unpacks at the end, it'll be fascinating. Property goes through the same stages of the market, and it's certainly starting to get a little expensive. I wouldn't quite say FOMO yet, but there's definitely FOMO in some suburbs. And I'm going to just cut to one of those suburbs, well, potentially. So this is realestate.com, their analysis of Noosa hits. So obviously that's where our office is. And it's been a fascinating market, many of our clients in Noosa. The current median price of a Noosa property is Noosa house, $1.3 million. That makes it the #1 suburb in all of Queensland. So it's the only state that has a regional suburb with a more expensive median value than anywhere in the capital city. So Noosa is now the #1 suburb in terms of median value. So that 1.32 million, and you can see if we go back to 2012, so roughly just over 8 years ago, it was 692, so nearly doubled in 8 years. So a nice return for investors there. Has it gone crazy? We're certainly hearing some crazy stories. We've had people like Gina Reinhardt move into town. We've seen some spectacular sales prices that are probably dragging those averages up, and that's filtering down through the Sunshine Coast. We're seeing the same stories in many other places, and certainly that's happening particularly in anything that's got lifestyle to it. Rural Australia has seen an uptick around all this as well. So hot property markets, it's going to be interesting to see if APRA regulate lending a bit tighter to try and slow that down. I don't think the Reserve Bank are going to push up interest rates anytime soon. They're happy to see any activity at the moment, including all the activity in the housing market. And there's a lot of new buildings going on, which is healthy for the economy as well. Let me wrap up, as always, with just reinforcing our process and that we believe all good investment decisions are best done as part of a real financial plan. That's one that has goals based on you, your life, with the portfolio designed to hit those goals in the long run. That means we can take a long-term view and we can do the smart things, massive diversification, a good asset allocation, maintaining enough liquidity that we never have to sell assets at a bad time. I'm going to wrap up there. You've heard me talk about that before. I look forward to talking to you. I'm hoping lockdown doesn't last too long in Brisbane, but I'm going to have a guess that we might be locked down, or certainly Brisbane locked down over Easter. Hope I'm wrong. Hope it doesn't spread to us here on the Sunshine Coast, and certainly hope it doesn't spread to anywhere else in the country. Till next month, stay safe, stay happy, and talk to you soon.